Welcome back once again to this session with Pinnacle Professional College. And today we'll be taking you through some international accounting standards. I hope you can stay with me while I walk you through the theoretical foundations of some of the key international accounting standards that we are aware of or that we are going to be examined on in the exam. Very, very key. Very, very key. We have a Telegram group as well. It's Pinnacle Professional College. If you search for Pinnacle Professional College as one word, you should definitely see us on Telegram. If you are not able to, the link is always in the description box of this video, or you can simply leave a comment and we'll send you the link. So let's move into today's objectives. There are a lot of things to cover, but for today, we'll be looking at IAS 38, which is the standard that governs intangible assets. So let's move into it. So what's an intangible asset? Right? So when we say something is intangible, it means that it cannot be touched or held. So that's what we mean by intangible. An intangible asset is an identifiable non-monetary asset without physical substance. It doesn't have physical substance. It includes items like licenses, intellectual property, brand names, trademarks, all those things are assets, but they are intangible. It's not something you can touch. It's not like a building that you can touch. You cannot touch an intangible asset. It has no physical substance. Now let's move on to the criteria. For an asset to be identified, for an asset to be identifiable, IAS 38, for an asset to be identifiable, IAS 38 intangible assets states that it must fall into one of these two categories. For an asset to be identifiable, IAS 38 states that it must fall into one of these two categories. Number one, it must be separable. It is separable. That is, the assets can be bought or sold separately from the rest of the business. The assets should be able to be bought or sold separately from the rest of the business. And two, it arises from legal rights. It arises from legal rights. So these are the two conditions that we are looking into here. It is separable and it arises from legal or contractual rights. We also know that since it's an intangible asset, it must also meet the definition of an asset, right? And usually we all understand the definition of an asset. An asset is an asset if it is controlled by the entity as a result of past events. So the intangible asset must be controlled by the entity. That's one. And it must also be a resource from which future economic benefits are expected to flow. So that's the normal definition of an asset. It's a resource from which future economic benefits are expected to flow. And an intangible asset is also an asset. Now let's move on to recognition. How do you recognize intangible assets? It must be interesting. Let's see what the standard has to tell us. This is only as I've already said, the theoretical foundation. I'm just laying the foundation for IAS 38 for you to understand what it's all about. To be recognized in the financial statements, an intangible asset must meet the definition of an intangible asset. It must meet that definition, which we've already talked about. And it must meet the recognition criteria of the framework, which is that it is also probable that future economic benefits will flow to the entity and that the cost of the asset can be measured reliably. If these criteria are met, then the assets should initially be recognized at cost. Very, very important. How also, if the intangible asset is purchased separately, right, it will also be recognized initially at cost. We said that one of the conditions was that it is separable. Always remember this, it is separable. That means that it can be bought or sold separately from the rest of the business. It's key. It's key. Please keep that in mind. Now, how do you measure it after initial recognition? After initial recognition, there's a choice between the cost model and the revaluation model. The intangible assets, when you are looking at the cost model, it should be carried at the cost less amortization and any impairment losses. And this model is the more common model. Well, we all know that amortization works in a similar manner as depreciation. So the intangible asset is amortized over the useful life, with the annual expense being shown in the statement of profit or loss for the year. Very, very important. Very, very important. Another thing you need to know is that an intangible asset with an indefinite useful life, the useful life just goes on and on till eternity. It's not definite. Should not be amortized. It should not be amortized. If an intangible asset has an indefinite useful life, it should not be amortized. And it should be tested for impairment annually. It should be tested for impairment annually. So here I say an intangible asset with an indefinite useful life should not be amortized, and it should be tested for impairment annually, and more often if there's an actual indication of possible impairment. So this is the cost model in summary. The cost model, for those of us who've watched my video on property, plant, and equipment, IAS 16, should understand the cost model. The intangible asset is carried at cost less amortization and any impairment losses when it comes to intangible assets. Please keep that in mind. Now let's look at the revaluation model. The revaluation model. The intangible assets may be revalued to a carrying amount of fair value. It's revalued. When it's revalued, it means that you are looking at the current market value of the intangible assets, less subsequent amortization and impairment losses. Similar logic. Fair value should be determined by reference to an active market. So that's what we talked about, the market value, the current market value. And what's an active market? We all know that an active market is a market in which transactions for the asset take place with sufficient frequency and volume. So the market is active. There's a lot of activity going on. There's a lot of buying and selling going on. And so pricing information is, constantly available. It's constantly available. But one of the things that IAS 38 says is that it says that active markets for intangible assets are quite rare. It's not often, and specifically prohibits the revaluation of patents, brand names, trademarks, and publishing rights. So that's something that IAS 38 says that, when it comes to revalue intangible assets, it's quite rare. You don't see it that often. As a guide, indicators of an active market would include the items traded within the market are homogeneous and prices are available to the public. So basically, it's giving us an idea what the whole notion of an active market is. Quite self-explanatory. Then there's something we call internally generated intangible assets. Internally generated intangible assets. As the name suggests. I'm sure you're having an idea. Generally, internally generated intangible assets cannot be capitalized, as the cost associated with these cannot be identified separately from the costs associated with running the business. Remember, we said intangible assets, one of the conditions is that it is separable. But when it comes to internally generated intangible assets, what we are saying is that usually it cannot be identified separately from the cost of running the business. And so we cannot capitalize it. The following internally generated items may never be recognized. Number one is goodwill, publishing titles, customer lists, etc. So that's something to keep in mind. It's quite difficult, Sometimes internally generated intangible assets, generally on a general scale, the keyword is generally, it cannot be capitalized because of the separability condition. It cannot be separated from the cost of running a business. Now let's talk about, we cannot talk about intangible assets without talking about research and development. Research is simply original and planned investigation. It's original and has an aim of gaining a new knowledge or new understanding. But development, on the other hand, is the application of research findings. It's the application of research findings. So research is original, development is applying research findings. So these are two different terms. Now, let's look at the accounting treatment when it comes to research expenditure. When it comes to research expenditure, you write it off as incurred to the profit and loss. You write it off as incurred to the statement of profit or loss. For development expenditure, you recognize it as an intangible asset if and only if you can demonstrate these things. That probable flow of economic benefits from the assets. These again, take your mind back to the conditions we outlined at the beginning. These conditions, let me go back and show you. These conditions, very, very crucial. These criteria, very, very crucial. So what are we talking about here? You should only recognize development expenditures and intangible assets if there's a probable flow of economic benefits. Also, if there's a reliable measure of development costs, if there are adequate resources to complete the project, and there's an intention to complete the intangible assets and use or sell it. There are several criteria. For example, it's expected to be profitable, etc. But I'm just mentioning a few for you to be aware. We've already talked about this in the beginning, like probable flow of economic benefits. You need that to recognize an intangible asset. Reliable measure of development cost. Yes, you need that as well. So these are very, very key conditions to be fulfilled for development expenditure to be recognized as an intangible asset. Very, very important. Very, very important. I hope you get the picture. It is, now let's read this. It is only expenditure incurred after the recognition criteria have been met, which should be recognized as an asset. Development expenditure recognized as an expense in profit and loss cannot subsequently be reinstated as an asset. So these are details that the IAS 38 is giving us concerning how to recognize development expenditure. So what you should know and understand here is that research expenditure is written off as incurred to the statement of profit or loss, right? And development expenditure, you can recognize it as an intangible asset if the entity can demonstrate that it meets the following conditions which we explained. There's a reliable measurement of development cost, there's a probable flow of economic benefits, there are adequate resources to complete the project, etc. So this is basically a brief theoretical understanding when it comes to IAS 38. We'll be looking into more details in subsequent sessions and try and answer some questions as well. So let's take a simple question. This is a simple question that to tease our minds. How should the following intangible assets be treated in the financial statements? Number one, a publishing title acquired as part of a subsidiary company. And number two, a license purchased in order to market a new product. So a publishing title, how should they be treated? The answer again depends on, can this publishing title be valued reliably? Can it be valued reliably? If it's possible, then the title will be recognized at its fair value. You could recognize it at its fair value, So you need to know whether we are going to be able to reliably measure it, which we've talked about as part of the conditions. Then number 2 is a license purchased in order to market a new product. So how will it be treated? Since this license has been purchased separately from a business, it should be initially capitalized at cost. So this is the separability condition here. And the first one, which was the publishing title question, was the reliable measurement condition, which we talked about. So this is a teaser on IAS 38. I hope you enjoyed this lecture. This is just the theory. So you can watch this video as many times as you want. We have a Telegram group, it's Pinnacle Professional College, all as one word. Just go search us, join the group. If you have any questions, you can drop it in the comment section. Thank you for listening and have a good day.